here's what's coming up on your horizon. Well, to say that 2016 was challenging for Oklahoma is a bit of an understatement. Economically, it was a tough year for several sectors of our economy, and it's being felt everywhere from Main Street to our classrooms. So with Auld Lang Syne still in our heads, we say goodbye 2016 and hello 2017. Stay with us for our annual New Year Economic Outlook for 2017.
Oklahoma Horizon is made possible by Career Tech, a job for every Oklahoman and a workforce for every company. With additional support from the Oklahoma Department of Agriculture, Food, and Forestry.
Hello everyone, thanks for joining us here on Horizon. I'm Rob McClendon. Well, today we begin the new year with our annual economic outlook, and for many, it could not come soon enough. In many ways, 2016 was a tale of two economies. On the national level, we saw a gradual yet modest growth, but here in Oklahoma, the downturn in the energy sector reverberated throughout the state's economy. With more on where we've been and where we're heading, joining me now is our Blaine Singletary.
Rob, Oklahoma has had a challenging 2016. 2017 isn't shaping up to be much easier, but economists say it could be a turning point for the state if policymakers can leverage the resources they have. First things first. Oklahoma's biggest economic driver, the oil industry, which has suffered from a downturn in energy prices, seems to be bottoming out and is ripe for a rebound.
It'll start turning around to be positive. It'll start contributing to positive growth so that we can actually start to see a turnaround in the Oklahoma economy. Not, gangbusters by any means, but in a modestly positive direction in an upcoming year.
Dan Rickman is a Regent Economic Professor at OSU and headed the 2017 Oklahoma Economic Outlook Conference. He says it's easy to look at oil as the final answer, but then you'd be missing the good news.
We've had growth in the state, in construction, in the education services, in leisure and hospitality. So we've had a number of sectors where we've had growth, but it was overshadowed by the decline in the energy sector and in manufacturing sectors that were closely connected.
It's a similar story across the rest of the country, where tepid GDP growth is expected to continue.
About 2% for the next 10 years as far as we can see. I mean, if you take the slowing the labor force growth and the fact that our labor productivity growth is really rather ordinary again, that adds up to about 2% growth per year.
So how then do we boost that GDP? Is there a way we can push that above 2%?
The boost will have to become in productivity because we're nearing full employment.
With the Federal Reserve planning to keep interest rates going up, productivity is the only way we'd see a boost to America's bottom line. And that's difficult to do through policy alone. At full employment, the only real way to boost productivity is through growing the workforce. And in Oklahoma, that's proving to be easier said than done.
Our labor force tends to grow slower than the national average. So if it's going slower, we'll probably go even slower yet. So we often rely on people moving from other parts of the country to get our boost in labor force and population. But of course that requires our economy to be creating jobs at a higher level.
Unemployment has remained consistently flat in the Sooner State, but that could be because people who have lost their jobs are leaving the state to find new ones. Couple that with fewer people coming into the state for work, and you can see the real problem.
We think it's pretty important on both sides that, businesses, when they talk about locating a business or relocating an office, they will talk to their employees, and if their employees say, no, we really don't want to live there, then the firm doesn't move there. So, at some point you have to be attractive to the labor force to get the firms to move there as well.
And Oklahoma hasn't been the most attractive lately, especially to young, college-educated millennials. While housing prices are lower, the quality of life is lacking compared to other states. And then there's the national headlines coming out of the state, highlighting Oklahoma's low teacher pay, amongst other things.
Rattled by unprecedented surge in earthquakes.
So we need to change the narrative. And so I think this maybe has to start at the governmental level, that we're really at a conscious level need to change, the perception of people.
And low teacher pay and low educational spending could bring about additional dangers for our economy.
And they talk about the size of their classes and how it changed the educational environment and achievement that you can get from the students. That's going to have long-term consequences, not to mention that it makes it harder to recruit teachers.
It's been known that people will pay much more to live in a neighborhood with good schools nearby. And on top of all that, if we want to continue that growth in those other sectors that have been doing well despite the energy downturn, we need to start educating our students for those fields today.
Obviously, we need further diversification. We're generally underrepresented outside the energy industry.
By keeping our own in the state and attracting others into it, Oklahoma can reclaim the spot it once had in leading the national economy. And the other big trump card in this equation is where the new presidential administration will take us in the next 4 years. Rickman told me it's still too soon to tell what policies will come out of Washington and how those will affect the Sooner State.
All right, thank you so much, Blaine.
You're welcome, Rob.
Now, when we return, a national perspective on the 2017 economy.
You're watching Oklahoma Horizon with Rob McClendon. Weekly insight into your changing world.
Well, as we saw firsthand in 2016, Oklahoma's economy is no island unto itself. As part of this year's Oklahoma Economic Outlook Conference, the president of Kavanaugh Hill Investment Management shared the things he's watching as we head into a new year. Brian, what can we expect in the labor market come 2017?
I think that we're going to see continued improvement. The unemployment rate today is the lowest that it's been as part of this recovery at 4.6%. That's data through the month of November. It's normal to expect the number of new jobs, that growth rate to slow down. We've been averaging about 180,000 nationally so far this year. And we may tick down a little bit less than that, but that's normal for at this point in the recovery.
Our gross domestic product seems to be stuck for the past several years. It's just right under that 2% level. Do you think that can improve in 2017?
I think that it can. I think the consumer is doing everything that they can is their part. They've certainly benefited from the improvement in the job market, but it'll be corporations that I think if lower corporate taxes or corporate tax reform is able to increase investment there from corporations, I think can have the potential to increase growth rates nationally.
Mm-hmm. Where does trade fit in here? Because by all projections, we should expect a stronger dollar.
Mm-hmm. So the economy, our U.S. economy has been growing much faster than our other trading partners, particularly Europe and Japan. The value of the U.S. dollar relative to those currencies, or the value of the dollar is relative to the macroeconomic factors of those countries. And because we are growing faster, the value of that dollar has been increasing. The United States is not a big exporter. Trade does not make up a large portion of our overall U.S. economy. We're more consumption-based. About 70% of the growth rate of the U.S. economy is personal consumption. Trade is 5%, something like that. So, but it does have an impact. I mean, the stronger dollar is just one little hurdle that our economy has to overcome. Even though it's a little bit, the trade is a smaller portion of the overall economy.
Mm-hmm. So, if consumption is driving our economic bus, what about consumer confidence? This last election, I would think one thing I would interpret from it is that there is some dissatisfaction with the status quo.
Absolutely. And consumer confidence has been on a rising trend along with the improvement in the job situation. But there has been a lot of uncertainty out of Washington, D.C., particularly on the fiscal side with the gridlock and infighting between the different political parties. I can tell you that the U.S. stock market has already put in a strong vote of confidence in Trump, with it trading at near all-time highs. Now, it's one thing to say that you're going to do these things, it's a whole other thing to get it done. So,
the stock market has been great for investors, but what about savers? Mm-hmm. It's been a really tough few years for savers.
because interest rates are very low, and in order to continue to generate the same amount of interest income for those retirees that are having to put even more money into the bond market, or perhaps even take more risks that they wouldn't normally be willing to take in normal times. And it's definitely concerning. We manage money and we caution investors against taking more risks than what their their portfolio would allow. And I would say that today. I would be very careful today in taking more risk than what you would normally do.
You know, for the past several years when we've done these economic outlooks, we've always talked about interest rates going up, yet they haven't. Is 2017 going to be the year?
Well, we've already seen longer-term interest rates rise about 50 basis points since the election. I think the bond market, being a discount mechanism, is pricing in a lot of the good things that the stock market has been cheering, and a lot of the things that's coming from the President-elect Trump. I fully expect the Federal Reserve to go slow with raising interest rates. Currently, the bond market is pricing in 2 rate hikes in 2017. Even with the programs and initiatives that the new administration is touting, cutting taxes, you're not going to see a huge increase in the economy right out of the gates. There's probably going to only be 2.5% maybe in economic growth. Inflation is going to still probably remain low. The dollar will be strong in holding back prices. Those are all deflationary forces.
Mm-hmm. I want you to put on your investment advisor hat on. You know, we are in this bull market right now, but oftentimes we don't see bubbles until they burst. Could we see a bubble burst?
You're exactly right. It's very difficult to detect when markets get overheated, when valuations are at absolute extremes before they get too far. We've had bubbles, booms, and bust periods for hundreds of years, and I fully expect them to continue. Now, I wouldn't say that we're necessarily in a bubble today, whether it's the equity market or fixed income market. There's parts of those markets that look very frothy, or that I think have a lot more risk versus the potential return in both markets, the bond market as well as the equity market. So today, investors always need to stay diversified, but I would say really, stay on top of it, keep your portfolio rebalanced, and meet with your advisor to make sure, given today's times and the outlook over to 2017, do we need to change a little bit of the overall risk that we're taking.
Are we going against some headwinds when we talk about job growth? Because technology is definitely a double-edged sword. While it does provide us with a lot of things, it can also replace some jobs.
Right, and a good example of that is to take a look at what's happened with Walmart versus Amazon. Amazon being the new age internet retailer, and its stock price over the last 10 years has gone from about $25 a share to over $700 a share. They employ about 260,000 people.
A lot less than Walmart.
A lot less than Walmart. Walmart employs about 1.5 million people, and the market, and their stock price is also has only gone up, from around $50 to around $70 today. And so it used to be that Walmart was kind of that disruptor in the retail industry, coming into communities, putting some kind of small businesses out of business. Now look at what's happening with Amazon. There's a lot, the growth rate of business happening online has been increasing. Amazon is that retailer disruptor. And businesses are continuing to want to do more with less people, reduce costs in any way, shape, or form, and they're relying on technology to do that. So it is a double-edged sword.
And I have to add, digitization doesn't just affect retailers. It's affecting my industry. I hear it affects your industry as well.
Absolutely. The healthcare industry, or my industry in the investment business, we've always relied on computer models to help us make investment decisions, pick stocks and screen investment bonds. But you even see it now on the advice side, where there are so-called robots that are set up to provide investment asset allocation recommendations for individuals. That is the trend even for the financial industry.
And many believe the economic disruption technology brings will only grow in the coming years.
Horizon is at your fingertips. Join us on Facebook, Twitter, and YouTube to catch the segments you may have missed and our latest new content as it happens.
Well, net farm income is down by 42% since 2013, and it's set to decline another 11.5% in 2017. But if there is a silver lining to this dark old cloud, it's that the latest downturn follows a historic boom for ag commodity prices. Not much solace, though, for those who are losing as much farm equity in 2 years as they gained in the previous 4. With more, here's our Austin Moore.
There has always been a romance associated with agriculture. The farmer in his field, the rancher on the range, each harnessing the soil and the rain to feed a hungry world. But this year, the bloom is certainly off the rose.
Farm incomes across the United States and here in Oklahoma are projected to be down dramatically. We've seen commodity prices across the board, both grains and livestock, under a lot of pressure, and that, of course, is impacting our net farm income.
Rodney Jones is an agricultural economist at Oklahoma State University. He recently joined fellow economists Kim Anderson and Darrell Peel at OSU's Rural Outlook Conference. To better understand this drop in income, we first look at cattle with Peel.
We had this phenomenal run-up in prices from 2013 into 2015. We peaked and we expected even that we'd probably gone a little too far. What nobody really did expect was how dramatically we would see prices adjust. So we're seeing prices now that are, 40 to 45% lower than they were this time last year.
And Anderson tells us the situation is equally upside down for wheat farmers, where a surplus of wheat worldwide has left our local numbers in the red.
You look forward to the cost of production somewhere around $170 an acre. The break-even price up into the $4.80 range, and the market's offering $3.60 right now. So you're looking at a $40 to $45 per acre loss on wheat given current market conditions.
Leaving farmers with the complicated analysis of managing for loss, meaning some will have to spend money only to reduce the amount of money they eventually lose.
So we got to look at the net return of each input on this wheat from now until we get it in the bin and harvest it.
And as Jones reminds us, these impacts echo throughout rural communities.
When we don't have money to spend replacing vehicles, replacing family living items, buying consumable items for the home, that obviously has a ripple effect, especially in our rural communities, areas that rely heavily on the agricultural industry.
So where will an upturn come? For grains, Anderson says, look to the skies.
It's weather, and it's not weather in the United States. It's weather in the foreign production countries, so Russia, Ukraine, the European Union, Australia, Argentina. What we're going to do, like we saw in 2010, where we got a $6 move in a 6-month time period, is we lost crops in the European Union, we lost them in former Soviet Union countries, we lost them in Argentina and Australia, and we got that $6 price move. You don't know when it's going to happen, and when it happens, you've got to have the wheat to sell then, because you can't wait till it happens and then grow the wheat.
For cattle, the path forward means weathering a different kind of storm.
Most of the time we talk about fundamentals and we talk about supply and demand, and ultimately those factors are what's going to dominate where we end up. The path to get there can be dramatically altered by emotions in the market, and particularly what has happened as a result of this dramatic adjustment down in prices is the entire cattle complex is really operating in fear right now. It's scared, we're falling, it's much faster than we expected, we don't know where the bottom is. And so we've got everybody panicked, and fear sort of becomes self-sustaining.
But fear leads to inaction, something Peel says is truly not sustainable.
If you're in the cattle business or in the crop production business or any other business, you got to get off the sidelines. You can run for cover for a while, but sooner or later you got to get back in the game. So I think the question now is to try to get people out of this paralyzing fear mode that they're in and get them to thinking about where's an opportunity here.
Because in those opportunities, this rough patch can be left behind and a new chapter turned in this great American romance.
Want to see more stories like this? All our segments are streaming on our YouTube channel at Oklahoma Horizon TV.
Well, just as our previous economist suggested, if there is to be a turnaround in our ag economy, we'll need some help from Mother Nature. While the global economy may well fuel demand, Mother Nature is in control of supply. At this year's Rural Economic Outlook Conference, I sat down with Terry Barr, the Senior Director of Industry Research for the Knowledge Exchange Division of CoBank. If we are going to have a higher dollar, it is going to make our exports more expensive. What does that mean for commodity prices?
I think for agriculture, the dollar obviously works against you. It keeps you less competitive in the global environment and so forth. The question really is going to become, do we make some of the needed production adjustments? And you know, you go back historically, it's not like we haven't been here before. I mean, if you go back and look, in the 80s and mid-90s, we had similar type accumulations of inventory and so forth. And they were resolved a bit through a surge in demand or particular adjustments on the production side. Now we had, if you go back in the 80s, we had
very different interest rates.
Very different interest rates, but we also had grain reserves in, we had acreage reduction programs, we had all kinds of commodity programs that really were trying to control the supply, control the surplus. We don't have any of those programs in place. Mm-hmm. Those programs have been moved aside and so forth. So as we go forward, that's going to be one of the questions I think that's going to be asked is, do we have the right set of farm programs for the environment that we're going to find ourselves in over the next decade? Because we always do farm programs on the basis of history. So when we do a farm bill, we typically look at what's happened over the last 5 years and we shape a farm bill. We're going to do a new farm bill in 2018. So it's going to be interesting to see, you know, what do we think the environment is that we're going to be preparing for. We have better crop insurance today than we had before. There's no doubt about that. We have price protection policies. We have revenue assurance programs. But are those the kind of programs that really lead to the adjustments that you want? Or are they the kinds of programs that just keep building your surpluses? So there's going to be a huge debate about, you know, the next direction for the Farm Bill. Are we on the right track? And again, it's all going to kind of link into this fiscal policy thing. How much money is available to do new programs, and how do we get the biggest bang for our buck? So that'll be a huge debate, I think, for agriculture, for the commodity groups in terms of, well, what's the best policies now for us, short-term, long-term? Because we've got what I would consider a short-term problem. I really could make a case down the road, you know, 2 or 3 years from now, that we could have a breakout on the global economy. That, you know, that if we did these structural things in all these parts of the world, we could have a massive amount of liquidity moving into the global marketplace, creating jobs, creating demand, and so forth. And so, you know, I don't think you want to do a farm bill on the basis of, oh, well, we're going to just stay in this subdued environment. That's never happened. I mean, we're going to get this straightened out. We're going to deal with these issues and so forth. And we're going to find ourselves with I think, a renewed growth on the commodity side. Another super cycle, if you will. What's going to trigger it? I think opening markets. India, tremendous potential if you could open their market and so forth. Get China's restructuring completed. They get back on track as a consumer-driven economy. The best thing you could hear is China's a consumer-driven economy from the standpoint of the food side. So I think there's some real reasons to be optimistic out there a little bit, but we've got this gap that we have to go through where we really kind of deal with the structural realities. And if we deal with those, then I think we open up this opportunity for kind of a new super cycle in commodities. And I think it's out there. The question is, how far out there do we move it by inaction? Do we keep kicking the can down the road, which pushes that reality further away, the longer we don't take action and so forth.
It's a booming industry that's all make-believe. Next time on Oklahoma Horizon, we look at the business of computer games and the jobs that power a $100 billion industry.
There's so many different kinds of video games, and there's so many different kinds of people that play video games, and I think it's just really interesting that everyone can come together and bond over something.
On Oklahoma Show for the Heartland, Oklahoma Horizon. Well, thanks for including us as part of your day. I'm Rob McClendon. Hope to see you back here next week.